Everywhere you go these days, there are the sign twirlers saying, "We buy gold." And if you turn on the television, commercials for gold, gold, gold. Yes, gold has gone up a lot in value recently. We are going to put that move into perspective to you. Also, the stock market is still near all-time highs itself. We are going to check in on earnings season, and we've got a lot more as well. Let's dive into it. So in the financial world, the last couple months, all we have been hearing about is gold and silver or silver and gold. Yukon Cornelius, if you haven't seen the claymation Rudolph, it'll be airing on CBS here in about a month or so. Our kids love that movie. But on a serious note, gold and silver have been going straight up. And so we wanted to talk about that move a little bit and put it into context. We'll start off by looking at gold. This is a 3-year chart here. And notice it had been steadily going up. One of the big drivers of this was there are a lot of investors out there who were concerned about the level of debt in this country. And this was a place that they were going hopefully for safety. And you can see that it has consistently been going higher these last couple years, but of late, over the last month or two, it has gone straight up, and we call that a parabolic move. Now, if you've watched our channel before, you know when we see parabolic moves, and it doesn't matter if it's in tech stocks, AI, Bitcoin, or gold, we always say you need to proceed with caution, okay? And unfortunately, that's not what's happening right now. In fact, here is a chart that looks at inflows into gold over the last 10 weeks. And this goes back to 2017, and you can see that it basically hit a 10-year high just over the last 2 weeks, meaning investors, as gold has gone higher and higher, are pouring more and more money into gold, and same with silver. Now, here is an exercise that I wanted to do because listen, a lot of people over the years with gold, if they ask me about gold, I say, what's the reason you're interested? The number one reason is people say, it's safe, it's secure, it's a store of value. So I said, well, let's take a look at that. So notice the chart that is in front of you. We just went over. Of these last 3 years or so, it's gone parabolic. Well, we have another chart that we want to show you, and this is from 2006 to 2011. And guess what? It looks almost identical as the one that we just went over. And the similarity, look at the end with a parabolic move that happened in 2011. I was here at that time. We were doing a blog at that time. And I remember I had several investors come in and tell me, hey, I would love to put my whole portfolio in gold and silver. Is that a good idea? And to which I said, I would not recommend it. Well, let's take a look at what happened following that August 2011 peak. The chart in front of you shows you gold, how far off its high it fell. And between summer of 2011 and the end of 2015, look at that. Gold dropped by almost 45%. And guess what? Silver was even worse. Silver dropped by almost 70%. Now, I don't know about you, but that does not seem safe and secure in a store of value to me. And guess what? This is not the only time we've seen something like this. Back in the 70s, gold and silver did very, very well, and especially late in the decade. And then from 1980 until 1999, a period of almost 20 years, gold dropped by almost 70%. Silver was down over 85%. So look, that tells us that these can be very, very volatile, especially if you're buying in when they have had parabolic moves, just like we have seen here. So the big takeaway is that when you hear gold everywhere you turn, you need to be a little bit cautious about how you proceed, because in the past that has meant that there have been a precipitous sell-off not too far around the corner. Now, another thing I want to mention, there are those over the years who have said, hey, maybe I want to own gold because it's an inflation hedge. If there's inflation, gold can do well. Well, 2022 was the worst year of inflation we've had since the late 1970s. And you would have thought that that would be a great year for gold. But from its top in January of 22 to late in 2022, gold dropped by over 23%. So again, that's a period it should have been doing very well if it was an inflation hedge, and it didn't happen there. Now look, we're not trying to tell anyone out there, and we know there is a group of people who are gold bugs. They're diehard gold and silver people. And guess what? That's been a good trade over the last 4 or 5 years. There's no doubt about it. But most people out there don't own any of those metals and are only now coming and are learning about it because it's doing so well. And we had a lot of people say the same thing about crypto and EV back in 2021, and each of those dropped by 70, 80% also in the following year or two. So take heed, be cautious if you haven't invested. That's the takeaway. On to the stock market, where the market has gone through this September-October period that is normally quite treacherous with very little volatility. In fact, the market has now had a gain over the last 6 months of almost 30% from the lows in early April, and the biggest sell-off during that whole period, 2.8%. So where do we stand now? Well, we are entering what is typically the best time of the year for the markets, November, December. And as we're in late October, we are now in the swing for third quarter earnings. And so I wanted to put up a chart looking at the S&P 500 earnings growth and take a look at where analysts thought profits were going to be for earnings of the S&P 500 and where it came out in actuality. So let's go and take a look at fourth quarter earnings. This was announced from kind of mid-January to late February. Expectations were 12% growth that you could see for the fourth quarter. Actual results up there at the top, 18.3%. We talked a lot about that at the time. Then we go, and by the way, the stock market did really well during that period. Then we went to first quarter earnings reports from mid-April to late May. Expectations were around 7% profit growth, came in at 13.3%. Again, the stock market went up a lot during that stretch. Then we go into the summer and have second quarter earnings. 5% was the expected growth rate, and that came in at 12%. And again, it's not unusual for a beat of expectations of 1% or 2%. But I'm sorry, these were massive beats, all 3 quarters there. So now we are here into third quarter earnings reports coming in. Expectations were 8% growth. So far, we've just heard from about 15% of the companies in the S&P 500, and we're on track for about 9.5%. We could very easily end up with growth of 12, 13% or higher by the time it's all said and done. But I always like to kind of keep you updated on what we're hearing from companies. We've heard so far mainly from the banks and financials and industrials. So, JP Morgan, Wells Fargo, Citigroup, Bank of America, the mega banks, all much better than expected results. Morgan Stanley and Goldman Sachs were strong, and American Express. You know, we love to talk about American Express, Visa, and MasterCard. We'll hear about Visa and MasterCard from them later on. But Amex was very positive on the consumer and on spending. The financials as a whole, very upbeat. That is a good sign for the markets. Then recently, we've heard from a lot of the industrials, GE, RTX, 3M, even General Motors and Delta, all better than expected, and the stocks of each of those companies went up a lot after they reported. And so it's early, but we really like what we're seeing here. We know that the tech companies are a critical piece. With all the excitement around AI and all the spending, we think that tech's going to have another very, very strong quarter. But that is good news. Let's put up one last chart on earnings per share. This shows you 2023, 24, and 25. Notice earnings profits in the S&P have gone up nicely each year. And in red, this is analyst expectations for the upcoming 12 months. And just take a look at the move that that red line has made higher here in 2025, up to nearly $300 a share, an all-time high. We've said this for a long time. In the long run, stocks go where corporate profits go. And so when you're getting this kind of growth in the long run, the market normally is going to be much higher as well. Let's talk a little bit about the jobs market. You know, the big story, and we have chronicled this really over the last couple months, has been around the jobs data. The fact that a lot of the data was pretty unreliable, and then now we have the shutdown, so we're not getting any new information in a lot of the key data sets that we rely on and the market relies on. But we wanted to highlight something again around non-farm payrolls. And these again, how many jobs are added monthly? This chart goes back really until late 2020. You can see from on the far left of the chart, up and through around June of 2022, you had a lot of jobs added monthly, nearly 1 million, because that was the recovery from the COVID days. I want to really focus in from kind of mid-22 on to recently in August. And notice that for much of this period of time, we've been kind of fluctuated between 150,000 jobs up to 300,000. That's been where we have been. But over the last 4 or 5 months, we have declined, and we have seen 19,000 jobs added, then a decline of 13,000. July saw a gain of 79,000. That was pretty good. And then August 22. So right now we are missing the September number. And in early November, we're supposed to get the October number. So if things aren't reopened, we still will not have those data sets. But this is going to be a key factor going forward that we want to see. We've chronicled that right now we have a situation where there hasn't been a lot of hiring, and there also hasn't been a lot of firing. That's the good news. Initial claims for unemployment insurance has stayed very, very low. Companies just aren't laying off many workers, but they're not hiring a lot either. Now, the last thing I'll say on this chart, last year during the summer, this dropped down into 87,000, 88,000, and in September, 44,000. We had some lower numbers, and then as we got later in the fall, it really picked up. Hopefully that happens this year, that number goes up as companies kind of get into the late fall period. Now, the last thing around the jobs market that I want to highlight, right now, economists are predicting over the next 12 months, on average, there will be 49,000 jobs created per month. If you go and look back at most of 24 and early 25, this was around 125, 130,000 jobs created is where they thought we would be. So this is one of the lowest numbers in quite some time. So again, this is going to be a key issue, I think, as we get later in the year in 2026. Now for rapid fire. And this is where I go over some of the key charts I think you need to know about. And we're going to start off taking a look at the price of a barrel of crude oil. Hit $57 a barrel. This was the lowest cost since early 2021. This means prices at the pump are going to continue coming down. That's basically almost like a tax cut for the public that they can then spend in other places. That is a positive development. Next, the Red Book Index. We talked about the fact we don't have a lot of data sets that we normally get to see what's going on with the economy, but the Red Book Index is still coming in on a weekly basis, and this tells us what's happening to retail sales year over year. And notice this just grew at 5.9% year over year, and I'll point out over the last 2 months, pretty much every week, this has been between 5.7 and 6.5% growth. That means consumers are still out spending. That's what we like to see. The third chart in rapid fire talks about investor sentiment around the stock market. Look, around gold and silver, it's very frothy, euphoric, but we take a look at investor sentiment, and this is a survey that asks a lot of investors, are you bullish? Do you feel great about the market? Are you bearish or neutral? And the bullish number right now, 33.6%, that is below the 5-year average of almost 36%. With the market near highs, it wouldn't be a surprise to see the bulls up near the top, and they're not there. That is actually a positive sign, because again, when everyone loves the market, it is on the same side of the boat. A lot of times sell-offs come out of nowhere. So it doesn't mean the sell-off's not going to come out of nowhere, but this is a positive development. Okay, now the last chart, and we are looking at the 10-year Treasury rate. This is for the nerds among us who really want to go deep in the weeds, but this is an important chart. This rate has stayed in the 4s all year long. And why does that matter? Because mortgage rates are based off the 10-year Treasury rate. And we're visiting 4 again, and I have some good news here as we film on Tuesday, October 21st. This is at 3.95%, the lowest level of the year. If it continues to go lower, that could take mortgage rates down into the 5s, which would be a real positive for the housing market, and that has a big impact on the economy as a whole. So the key takeaway is around gold and silver. And look, it is true that they have had incredible runs the last couple of years, but recently they have gone parabolic. And as we talked about, it doesn't matter what the asset class is. When you see a parabolic move, that is a major caution sign. You also need to know why you own it. If the reason is because you think it is safe and secure, we showed you that that has just not been the case. It has had significant declines in the past and gone 20 years where it went down. That is a long time. We also talked about the stock market. It has been propelled higher by earnings season so far. Can we go 4 for 4? Well, we're off to a good start with the financials and industrials leading the way. Thanks for watching and take care. Hey, thanks for watching our video, and don't forget to like and subscribe to the channel. Turn on the notifications. That way you don't miss any market updates going forward. And if you're new to Centera Capital, you can head to our website and go to the contact page, reach out to us. We have a 3-meeting process to see if we are a good fit to each other. And if your advisor isn't giving you market updates, we'd love to talk to you. Thanks for watching and take care.